Hi, everybody. Today's Monday, September 8th, and we are going to review our latest Bitcoin intelligence report, which looks at the market, economy, on-chain, and liquidity trends as it relates to Bitcoin. So if you log in our platform, you will see the latest report, and we've titled it Economy Cracks, Bitcoin Fragile, and the Fed is About to Panic. I'm going to read some of the highlights for you. Labor market weakness and revisions. This has been very critical last week. One of the biggest economic events that showed the labor market is indeed on a path towards significant cracks in employment. August payrolls added only 22,000 jobs versus 75K expected. So less than a third of expectation. This was a 3 sigma miss by the economists and by forecasters. In addition to that, we had large downward trends, which if you add up all the revisions in 2025, this is about 500,000 jobs erased during revisions, and that's about as big as the population of Atlanta. So why does the data miss so much? This typically happens when the economy moves from a strong trend to downtrend. All the models are thrown off their path, and so you get massively more revisions. Exactly happened during 2008 and other economic downturn eras. The economic models are made to force the data to be smooth and function on a linear basis. When trend changes, they fall behind and you get more and more revisions. And these revisions have been increasing. And some of them have been historic. So in just the month of June, initially was reported to have 133,000 job gains. Then it was revised back down to about 14,000 jobs. And then it was revised further back down to actually job losses of 13,000. So this is the first negative month since 2020. This is the beginning of weak labor data, very weak labor data. And this is certainly going to put the Fed into panic mode and have them drop rates precipitously. When you look at the under the hood, you see broad-based slowdown in the economy. We'll look at some charts related to that, and the implication for that for the markets is very nuanced as well. It is likely that this can cause an initial sell-off in the risk asset during the next few months, but as the Fed cuts the rate and unleashes a stimulus, it's very likely that the sell-off will be negated by these efforts, and then after that, risk assets will begin flying. So this actually is likely to put us on a path of a double top sort of in this cycle for Bitcoin, where we have once gotten to 124 and then corrected back down, and then another leg begins because of the change in the Fed's policy. And when you look at the on-chain data, it still keeps showing weakness. Momentum is slowing. People are beginning to slowly sell at a loss, and still not an extreme level though. And we will also look at some liquidity trends. Okay, so on the macro chart, I told you that we have had economists missing the mark. As you can see, this distribution shows what they had predicted for this month. The median was 75, and what actually happened is 22. Yeah, this is about close to a 3 sigma miss, which doesn't happen often. It's a very weird situation. And we talked about revisions. Revisions are really, really big and very worrisome. And this is perhaps the key chart that summarizes the situation. the U.S. economy has barely added any jobs in the past 3 months. So you can even include May, and nothing substantial has happened. 1 month of less than ideal job creation by 79,000, and then the rest of the months, either a small job creation in August, 22,000, or job losses, which was in June, 13,000. So if you look at the labor trends, we came down from the highs of COVID up to here, then we pretty much stayed flat since then. In the last few years, in the last 2 years, we've been sort of in this soft landing situation, which got the Fed really happy. And then from that point on, we have 4 data points showing a clear decline from the soft landing to a harder landing world. And this has, unfortunately, this has the potential to become nonlinear and grow very fast into a bigger problem. Now, one of the additional problems with this data is that when you look at the what's under the hood, you see that the the industries also are showing really bad signs, because most of the positive part in the 22,000 job creation was because of healthcare. If you remove healthcare, we lost jobs. If you combine everything else, and healthcare is basically a mandatory part of the economy where it doesn't really slow down. Whatever happens, you have to go to the doctor. You'll compromise on all the other discretionary things, but healthcare should be there. And then it's not very productive, right? It's not very productive for the economy. It's basically maintenance for the ill. Now, the second biggest category was leisure and hospitality, with 28,000 jobs. And pretty much everything else included very weak growth or job losses. So the majority of the economy is now losing jobs. And the best place that's gaining jobs is healthcare. And this gets very scary if you actually try to separate healthcare from everything else. That's where you actually get the clear trend. And what we see here is the gray bars are healthcare, the blue bars are the rest. And when you look at it that way, you realize that sometime pretty much exactly aligned with Trump presidency, the 3 months average of the all other industries, non-healthcare, started dropping, but it was at a positive level. Now it has dropped to negative. So if you eliminate healthcare, a massive drawdown is obvious. And this is very worrisome, right? Because it can continue and it can actually accelerate. And the Fed knows this, and they have already discussed this in the past meeting. And they said, if things go like this, we will quickly be back down to our zero bound. Here's a great chart from FFTT. They show that they look at JOLTS, which is the number of job openings compared to unemployed people. So unemployed people are the pool of labor that's looking for jobs, and JOLTS shows how many jobs are now open and available for them. Now, typically, JOLTS is bigger because there's a lot of fake job postings and also a lot of job postings that never get filled. So generally, JOLTS data, job openings, and that's on the blue line. These are larger than the unemployed population. So, but occasionally what happens is the number of unemployed people in the economy end up being larger than smaller than the JOLTS data. So here, when you look at what we had after COVID, was after they unleashed all that stimulus, the JOLTS data jumped up. Although in the past, because we haven't had all the modern data collection methods and online platforms, maybe JOLT data is way lower. After COVID, we had this situation where JOLT persistently stayed higher than unemployment, and it didn't lose a signal; it just went up one level. But nevertheless, it has been higher than unemployment for at least 4 years now. And this gap has been a sign for the Fed to say that the labor market is strong. We had a similar situation before COVID, but again, over a very long period of time, the JOLTS level changes because of job posting practices and so on. But nevertheless, when you look at recent history, JOLTS numbers job openings have been coming down, and this shows a very clear downturn, which is, indicating that the tightening of the economy has been working, and the demand for labor has been coming down. Recently, the two met, and demand for labor is now lower than unemployed numbers in the economy. So now there are less jobs. There are fewer jobs than unemployed people. So that means if unemployed pool had trouble finding jobs already, this is going to compound and get much worse. And this is another sign that even the job opening numbers that has been in the recent history way larger than unemployed people, even that is now gone. So it's very unlikely for unemployed people to be able to gain substantial jobs. And as a result, there is more weakness to come for the labor market. Now, is this bullish or bearish? This is a key point. When things like this happen, investors rightfully sell risk assets because this shows a slowing economy, and they rush to bonds. But every cycle that we see this dynamic, the Fed improves in how fast they respond to the drawdown. And whereas in 2008, they took a long time, and then they allowed the risk assets in the stock market to crash pretty hard, and including the housing market. In 2020, they were much faster, and the Fed and the Treasury worked together to unleash massive stimulus into the economy. And as you can see, as the unemployment numbers shot up, they rapidly brought it down, together with many more job openings that were created because of that stimulus. So they have learned the tricks, and they have created the tools. Now, when unemployment jumps, they are going to rapidly increase liquidity, which will come in the form of government deficit spending, and lower rates and quantitative easing, all of which will inject more liquidity into the market. However, they won't do this unless there is some pain, especially pain in the labor market, right? So now we are seeing the beginning of the problem. So what they're going to likely do is slowly cut rates and slowly support liquidity. And then we will see if the actual non-linear drop in labor market begins to emerge, and we get one very concerning jump in unemployment, then that's where the green curve, which shows deficit spending as a percentage of GDP, is going to ramp up pretty fast, and everybody's going to drop lots of liquidity on the market, and because they can't surgically direct liquidity to where it's needed to create more jobs in a downturn, they will throw liquidity at anything and everything, which means even assets that don't necessarily need that liquidity will go higher, and especially hard assets will go higher. And among those hard assets, the hardest one is Bitcoin. So Bitcoin is likely to absorb a lot of that excess liquidity that these people are going to throw at the market and start a new uptrend. So the most likely outcome that I see here is a short period of panic for investors as we show signs of a recessionary trend, and then as the Fed changes policy and perhaps even the administration will do things, because pretty much a big portion of what we see here is caused by the uncertainty from tariffs and the global trade uncertainties. Maybe the administration would loosen some of those restrictions and maybe back down from some of their tariff requirements, or do other things. For example, they could float a tax cut or maybe a distribution of what they have collected from tariffs to people in the form of stimulus checks or some sort of loan, small business loans, or anything else that revives the economy. And being Scott Bessent, being in the industry in Wall Street for many years, he knows a variety of ways that government can stimulate the economy. So this is, again, my point is, this is kind of a man-made problem. It's not a natural trend in the economy that no one knows how it emerged. It was caused by a small number of people making decisions that led to the weakness in the economy. And the moment they want, they can reverse it. And so you will, even if we get volatility in the short term, it's solvable and it's fixable. And so everything that I said boils down to another V-shaped market. We called the V-shaped recovery earlier in 2025, happened exactly as we predicted. And this is another setup that in my mind is going to look a lot like that initial V-shaped trend that we got. All right, and then the rest of the report, I also covered the yield curve. You could read that, and the rest of the report dives deep into Onchain from one of the best Onchain analysts in the market, Wizard, who is looking at realized volatility compression and realized cap flows that are slowing, and short-term holders that are beginning to sell at a loss. And generally, the momentum is not positive, not great. You can make sure you subscribe to our reports to be able to read it in detail. And Renault is an expert in liquidity and monetary mechanics, which is very critical for Bitcoin. He's also analyzing what's happening with liquidity around the world and the central banks and yield curve and so on. So definitely check this out. This is a very detailed report that we publish every week for our subscribers. You can join at 21stcapital.com/BI. Just B and an I for Bitcoin Intelligence. All right, I hope this helped. You can send comments at the end of this report. Make sure you share your thoughts with us on here or on social media. All of us are on Twitter as well. You can find us. Thank you very much, and I'll talk to you next week.